Welcome to vTalkInsight, Market Drivers Daily for February 2nd, 2026. Today, markets are wrestling with a potential shift toward a more hawkish Federal Reserve at the same time that the AI investment cycle is reshaping growth, inflation, and liquidity across assets. Let's unpack how expectations for higher for longer rates, a smaller Fed balance sheet, and more selective AI enthusiasm are feeding through to bonds, equities, and credit. The rate story is rotating from hopes of rapid easing toward an acceptance that policy may stay restrictive, with quantitative tightening still in the background. Incoming data show inflation running near 3%, below the peaks but still above the Federal Reserve's 2% goal, while policy rates remain above 5% and unemployment is under 4.5%. That combination keeps the focus on higher for longer rather than on an aggressive cutting cycle. Recent producer price numbers reinforced this narrative, with headline PPI rising around 0.5% and core closer to 0.7%, driven largely by services. That challenges the idea that only goods inflation is problematic and complicates the case for imminent easing. In rates, the reaction has been a clearer steepening of the Treasury curve. Long-end yields have pushed a few basis points higher, while two-year yields are flat to slightly lower, reflecting expectations that any future cuts will be modest and that term premia may need to do more work. Markets are also reacting to the prospect of a Fed leadership that is explicitly uncomfortable with a large balance sheet and past quantitative easing. Both Kevin Warsh and Kevin Walsh are associated with a preference for a smaller Fed footprint, a return to scarcer reserves, and less willingness to use asset purchases as a primary tool. That points to a QT bias and to structurally higher term premia, especially in the 10 to 30-year sector. Treasury issuance has already shifted toward shorter maturities in response to long-end weakness, which supports bills but can raise pressure in money markets and leave the back end more sensitive to shifts in Fed rhetoric. For risk assets, this backdrop implies a thinner safety net. There's growing commentary that the perceived Fed put has moved further out of the money, with less expectation of swift support for equities or credit if volatility spikes. Liquidity-driven segments, such as cryptocurrencies and high multiple growth stocks, appear particularly exposed. U.S. investment-grade credit spreads sit near historic tights, even as significant leverage is being raised to fund AI-related capex. That leaves credit markets vulnerable if a steeper curve and higher real yields start to reprice duration and balance sheet risk simultaneously. There is, however, a meaningful counterview that tempers the tightening story. Some policymakers argue that current inflation readings may overstate underlying pressure, pointing to measurement quirks in areas like housing and financial services. Others highlight AI-driven productivity gains and a positive supply shock that could push the neutral rate lower over time. Within the Fed, participants still see the next move as a cut, and markets have only scaled back expectations from 2 cuts to roughly 1, mainly in the second half of the year. The modest response of two-year yields and the resilience of equities suggest that a more hawkish stance is partly priced in. From here, inflation prints, especially in services, and the behavior of the long end of the curve will be critical. How far term premia rise and whether tight credit spreads finally widen will set the stage for how much pressure this higher for longer regime puts on portfolios. The policy pivot debate has evolved from a narrow question about when the first rate cut arrives to a broader question about what kind of Fed will be delivering it. Compared with the watchful pause we discussed recently, markets are now preoccupied with leadership risk, central bank independence, and the balance between inflation control and political pressure. Rumors and reports around candidates, such as Kevin Warsh and Kevin Walsh, have been interpreted as a tilt toward a more hawkish chair, particularly on balance sheet policy and quantitative easing. Both are seen as inflation-focused, skeptical of large-scale asset purchases, and more comfortable with allowing long-term yields to rise, even if that tightens financial conditions. At the same time, There are concerns that some recent dovish remarks may be politically motivated, raising questions about how firmly a new chair would defend Fed independence once in office. Senators have signaled unease about potential political interference and have linked confirmation of new nominees to the resolution of Department of Justice and Supreme Court cases involving current Fed officials. The confirmation process itself looks likely to be lengthy and contentious. Ongoing investigations, committee bottlenecks, and vocal opposition from some senators all point to delays, and there's even a scenario where the chair role is temporarily vacant, though the Fed would still have a quorum for decisions. Despite this, market pricing has been surprisingly calm. Moves in the long end of the curve and in major equity indices have been modest, suggesting investors believe the Federal Open Market Committee and institutional constraints will limit abrupt shifts. Where the leadership debate does matter is around the perceived strike of the Fed put and the outlook for global spillovers. A chair who is less willing to deploy QE or to lean against market stress implies more two-way volatility in rate-sensitive assets and potentially a higher-term premium embedded in Treasury yields. Markets still price most cuts in the second half of the year, but there is growing recognition that if those cuts are fully priced out, it could trigger a meaningful move higher in yields and a renewed U.S. dollar rally. That would have repercussions for commodities, emerging markets, and any asset class relying on cheap dollar funding. The counterargument is that the identity of the chair may matter less than the appropriateness of the policy stance. Several observers emphasize that the Fed remains a committee, that data will drive decisions, and that a candidate like Walsh could even strengthen perceptions of institutional independence and support steady capital flows into the dollar. There is also the White House narrative of a positive supply shock, reinforced by AI-driven innovation, which if correct would ease the trade-off between inflation and growth and reduce the need for overtly hawkish policy. Key watch points are the tone of Senate hearings, explicit comments on balance sheet strategy and digital currencies, and any shift in market pricing from 2 cuts toward 0. That policy backdrop feeds directly into our next topic, because AI is no longer just a growth story. It is reshaping how investors think about inflation, productivity, and the credit cycle. AI remains the dominant structural growth theme, but markets are getting more demanding about where massive capex actually translates into revenues and cash flows. What was a broad enthusiasm trade is becoming a more forensic process of sorting winners and losers across hardware, software, and platforms. Recent big tech earnings underline this shift. Apple delivered record iPhone sales and strong growth in China. Yet investor focus stayed squarely on the company's AI monetization roadmap and its ability to integrate AI into services. Rising memory and chip costs are expected to push future iPhone prices higher by roughly $100 to $150, but margins are seen as secondary to the long-term AI and services revenue opportunity. By contrast, Microsoft's cloud business missed elevated expectations, and concerns over data center capacity and the payback on AI infrastructure drove a sharp share price reaction. Meta and others with clearer AI deployment stories have been rewarded, showing how sensitive sentiment is to near-term monetization signals. Beneath the headline volatility, a powerful hardware and infrastructure cycle is taking shape. SanDisk and other storage names have surged on the back of AI-driven demand, with customers signing multi-year orders that reduce traditional cyclicality. Western Digital sees exabyte demand growing at roughly a 25% compound rate over the next 5 years, driven by cloud and AI workloads. Tesla has committed around $20 billion to AI infrastructure and robo-taxi deployment, while discussions about combining Tesla, SpaceX, and xAI hint at an even larger capital market footprint. At the same time, U.S. investment-grade credit spreads are at historic tights, and much of the funding for AI data centers, chips, and power infrastructure is coming through leverage. That makes this AI capex cycle more intertwined with rate volatility and yield curve steepening than prior tech booms. AI is also feeding directly into the inflation and policy debate. Short term, the build-out of data centers and compute is lifting input costs, with U.S. electricity prices up around 7% and materials like metals and construction inputs in high demand. Silver's dual role as an industrial and precious metal is benefiting from strong manufacturing and AI-related demand, even after a sharp reversal from a retail-driven options mania. Over the medium term, voices such as Kevin Warsh argue that AI-driven productivity gains could lower the neutral interest rate and ease inflation pressures, potentially allowing for lower policy rates once the current investment surge settles. That leaves AI sitting at the nexus of both growth optimism and inflation uncertainty. Valuations are at the heart of the current AI discussion. Some investors warn of an emerging bubble, pointing to tech-led drawdowns, sharp moves in names like Microsoft and European software, and pockets of speculative excess in metals. Others argue that for major public AI leaders, including chipmakers and cloud platforms, valuations remain reasonable given that the sector is still in an early growth phase and that switching costs between large language models are falling, which may expand the addressable market. The prospective reopening of the U.S. tech IPO market adds another dimension. High-profile listings from firms such as OpenAI or Databricks, alongside potential transactions around Musk's ecosystem, could redirect liquidity, reset private and public valuations, and broaden investor access to AI exposure. From here, the key signals will be AI-related earnings, capex guidance, power price trends, and the timing and structure of any major AI IPOs. Together with the evolving Fed narrative, these will determine whether AI continues to act as a stabilizing growth engine or becomes a source of macro and market volatility. To wrap up, markets are converging on a higher-for-longer rate path with a bias toward continued balance sheet reduction, even as the identity of the next Fed chair and the strength of central bank independence introduce new uncertainties around the policy reaction function. At the same time, AI remains the core growth engine, but leadership within the theme is fragmenting as investors reward clear monetization, scrutinize balance sheet leverage, and weigh the inflationary impact of surging energy and infrastructure demand. Watching how inflation data, Fed communication, and AI earnings reshape expectations for cuts, term premia, and credit spreads will be critical for understanding cross-asset performance in the months ahead. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.